Hello and welcome to Options Guide TV. My name is Brian Overby. I'm the author of the Options Playbook, and I am going to be teaching you about cash secured puts today. The markets are closed for the Memorial holiday, so I put together a little slideshow, and let's run to that slideshow right now. And I want to introduce to you cash secured puts, and in particular, I want to talk about this in a volatile marketplace. So, what is a cash secured put? Let's start by defining that. If I grabbed this from my website, optionsplaybook.com. And if we're looking at a cash secured put, the concept of it being cash secured means that you have the capital to buy the stock at the strike price. Now, what makes the strategy powerful is that you can actually do this in a retirement account as long as you have the approval to be able to buy stocks via a cash secured put, meaning you have the cash in the account. You can't sell it without the cash. You can't speculate and be naked that put option, but you can do it cash secured. So by having the cash in the account to buy the stock at the strike price, what you're saying is that the stock is trading somewhere above the strike. You sell a put below this with a strike price that's below the stock. And then if the stock comes down, they put it to you at that price. You pay for it, but you get to keep the premium for selling that put option. So hence your break even moves down from the strike minus the premium received. And once you get put the stock, that is your break even point on the stock. And you have unlimited upside and substantial downside because you're a stock owner. That's the concept of doing it. Now, I want to look at a couple of cash secured puts. And one of my biggest rule of thumbs, let's move out again real quick like. And one of my biggest rule of thumbs is that I want to do them on stocks that have some volatility and some predictability. So if I'm doing this, I want, in our example here, we're looking at the Tradier Pro software. And if I'm doing this trade, cash secured puts aren't exciting on stocks. You might want to buy them, but they just don't have any volatility. They're very boring stocks. If they don't have any premium, it's a lot less enticing to sell the put option. Just buy the stock or put a limit order in, right? Why have to deal with the actual options marketplace if you're not getting paid for saying that you're willing to buy it? And how do you get paid? You have higher implied volatilities. Okay, so a solid company in the semiconductor space has kind of got beaten up. Once again, the trade wars and conversations have hurt the big stock NVIDIA, which we recently did a covered call on steroids on, and that was part of an Education Monday that we did. But here we're going to look at Applied Materials. And the stock right now is trading at 156.65. We're using live markets. We're taping the show today on Friday, May 23rd. And we're saying if the stock does come down below, a little bit lower than where it's currently trading, I'd be willing to buy the stock at that strike price. Well, the strike price that we're going to look at here is the 155 strike price. And here is the put sale down below. Selling 155 put. We're bringing in $5.60. That's where the midpoint is at. So I'll click that, change that up. We'll make that our midpoint right now with Implied Materials at 156.63. Okay. So if I'm going to be selling puts on stocks that I want to buy, I want to buy the stock. So first of all, I'm going to sell something closer to the strike because I'm hoping that it gets put to me. I'm done my research. I want to own the stock. Now, next off, the biggest thing about doing this on stocks that you want to own is I think the most risk is that the underlying stock takes off and you don't get the opportunity to buy it. So with that in mind, the amount of premium that I receive for my put option is my only reward. And so I always want to have the goal of making 4 or 5% on the premium relative to the cash that I have secured to buy the underlying stock. So in this instance, and I'm going to do the math real quick like here, $5.60 premium using a live market with the Applied Materials at 156.40 means that we're looking at 3.5% premium. To me, that is too low. I'm not receiving enough cash for the risk of not buying the stock, right? So I approach cash secured put selling, especially in volatile times when you're getting some premium, with the concept that I would rather sell something just in the money and get that premium. And if the stock continues on up, I get a little bit bigger, quote unquote, dividend, right? It's not a dividend, but it's income that you're receiving on a stock that at this point we don't own. So the reason why I chose the 155 strike put is this is a very viable put that somebody would probably sell. We're going out, I think it's 28 days. Let's go look at it. Yeah, the June 20th expiration. It's 28 days out. But if I were to implement this strategy, I would look at selling the 157.50 strike put. And I'm going to hit that bid. Very less uncommon to do, right? And now you're looking at bringing in $6.78. So 678 divided by 156.55, we're looking at 4.3%. All right, somewhere between 4 and 5%. So the moral to my story on Education Monday is, first of all, it's okay to sell a put option a little bit in the money. You're still saying I will buy it at the strike price minus the premium received, which is quite a bit lower than where the underlying stock is at. Now, if the stock gets put to me, I should be happy about it. I should be happy, right? Because I wanted to buy the stock. If the stock is not put to me, I should be sad. But I have a little bit of pillow to cash to lay on while I kind of whine about the fact that I didn't get put that stock. So if the market does go up in implied materials, and it's down quite a bit today, but because the market in general, like I said, a lot of news out of Washington today, once again, heading into actually a holiday weekend. It doesn't happen that often, but it's happening today. And at my cost basis on this underlying would be that strike price minus the net premium paid for that option contract. So we'll stay right here right now, and I'll just do the math, and we'll talk a little bit about it, and then we'll run back to the PowerPoint. But so 156.61. Well, what we do is take 157.50 minus that premium. We're going to call it we'll call it 680. Okay, we'll give ourselves 2 pennies. And so we'll go 157.50 minus 680. I'm still looking to buy the stock down around the $150.70. That's where I would be looking to buy the stock at. So if the stock goes up and I don't get the opportunity to buy the stock, I'm making 4.3%. That's a very, very, very hefty dividend over a 28-day period. And let's say I try it again and I sell something and I make another, let's call it 4.5%, and I miss it again. Guess what? I just made 10% on a stock, right? I made 4.5% twice, or approximately 9% on a stock that I never bought. And that's the moral to my story, because I can do that over a 60-day period when I'm selling stocks cash secured. So the focus of a lot of people is, I want to see how much premium I can get if I don't get put the stock, or I sell this trying not to buy the stock. So a lot of people might sell the 150 strike put option or the 140. But if the stock runs away from you, that capital didn't earn enough money to make me okay with the fact that I sold that put option saying that I want to be put that stock. So let's run back out again real quick, like I'm keeping a close eye on this. And let's go back to the PowerPoint. And we're going to look at the cash secured PowerPoint. And I'm just going to highlight a couple of things to think about. All right. So in this instance, evaluate the premium collected relative to the risk of not buying the stock. And I don't think enough people put enough emphasis on this on cash secured put writing. Now, also understand that you want some volatility and some predictability, but higher premiums might indicate very greater volatility. As a matter of fact, I thought about using NVIDIA as a cash secure put example, but they're announcing earnings. And I don't think I want to do this around earnings in NVIDIA. I don't mind it because I don't mind buying 100 shares of NVIDIA. I think long term, I have a fairly decent bullish outlook on it. But with that said, I don't want to do it around earnings. If I did anything around earnings, I would go out and maybe buy a long call spread for that earnings event so that I don't, quote unquote, miss out, and then sell a put after the earnings. There's enough premium, there's enough volatility in NVIDIA that I can go out 30 days and get 4 or 5%. Now, if I'm going out and I'm looking at Walmart, for example, right? Walmart just announced earnings. They got a little bit higher implied volatility recently because they've had news headlines. But in general, that's a tough one to sell puts on because 30 days out at the money, I'm only getting about 2.5 to 3%. And I just don't think that is enough on the capital that you're securing to buy the puts. All right. And don't forget that you might not be assigned. Like if the stock comes down right here, I guess I moved this bullet over a little bit. Can you control when you'll be assigned? You can't. So if the stock does come down in applied materials and you want to be put right away, you can't make that choice. I would love to be put and get the stock and get the premium and get it right away because I want to own the stock, right? But you're not in control. You sold it, you received the premium, you took on an obligation, you're not in control. So keep that in mind that you're probably going to get assigned closer to that expiration date. Then I get people that ask all the time, is it okay to roll your option up or down? And the answer is no, I'm not rolling the option. I'm not looking to do that because I want to own the stock. Now, you could say, well, and the great example would be in NVIDIA. Apple today. Apple had the part of the news headlines is that there might be a tariff put on iPhones. And so Apple is down quite a bit today. And because you received that news, just close the put, right? If you don't want to buy the stock, just stop all the madness and buy the put back and close it and find a better time to maybe sell puts on Apple if you wanted to buy stock at a later date. So that's a great timely example of I might have had a short put out there on Apple saying that if it broke below $200, I wouldn't mind buying it at a little bit lower price. Still a solid company, right? Magnificent Seven stock. But with that all said, now we got a news headline and the whole story has changed. How are they going to deal with that? All right. So that's going to be it for this edition of Education Monday. Don't forget that if you're selling cash secured puts, think a lot about the premium that you collect relative to the risk of not buying the stock. And that's the way I like to think about cash secured puts. In particular, when markets are volatile, I want to make sure that if that stock takes off, that I collect enough premium that I'm not going to shed a lot of tears on my pillow overnight because I didn't get to buy it. Options Guy TV every Monday, Wednesday, and Friday inside the Tradier Hub at 11 a.m. Eastern Time. Please check me out.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.